Oh, Nathan's. Oh, there we go. What's happening, y'all? Christopher Griffith here for your weekly update on what's going on with the mortgage market with Hammer. So, I don't want to start saying Hammer time, but I kind of do.
You could. I feel like we've missed an opportunity. We should have staged where you slap me or something, because that seems to be what gets everybody's attention these days. Is
I don't have any parachute pants anymore. But if you hop on here now or you hop on here later and you have questions about some of the topics that we're going to cover today, feel free to drop them in as questions. If you drop them in and during the live, we'll pull them up, answer them, and address them as we're moving forward. But the goal of this live video is the same every week, and that's to keep you informed of what's going on in the mortgage rate market or the mortgage bond market, right? And some of the things that are happening or could happen here in the very near future and how that may change it. So a lot of you have questions on what's going on now or who's at wherever else, right? And we tell you to shop because that's the only way that you can be sure that you're getting really the best opportunity that you can find. But we want you to have some basic understanding on what's going on in the market. So that said, Hammer time.
When we talk about shopping, maybe next week I'll make a note of this. We should put some parameters out there of how to shop, what really to listen to and what to ask, and what to listen for and what to avoid. We should do that.
Yeah, I think that's actually part of our agenda on some of the courseware we're building for veterans to show them kind of what to do, talk them through what our methodology is and what we think they should be aware of and how to shop and what to look at and all of that. We can probably do that live here, but we're certainly developing some stuff for y'all as well. If you're listening.
That's awesome. That's awesome. Clyde, good to see you, my man. I'm looking at the comments. I see Clyde on there. So, why don't we do, especially for those that just want to see what's going on and maybe don't have a lot of time, and maybe those that are watching on the replay, why don't we do a quick rate recap? Let's talk about where rates are at, where they're going. Nathan, would you mind go ahead and show the screen for a moment? We'll do that. So here we are. It's March 30th, 2022, just so we all have a reference point. We all know that. So for this week, which started on March 28th, let's do a quick recap of last week. Rates moved higher, and they did so pretty quickly. Most lenders saw rates move up as much as 0.25%, which I remember when I was actively writing loans back in the day. We're talking 20 years ago. That wasn't a big deal, but we've really grown accustomed to seeing rates very low. A lot of you may have grown accustomed to seeing rates that were started with the 2s or even the 3s, and now you're seeing the 4s and maybe even the 5s. And that is legitimate. It is happening, and that is happening. We'll talk about what's actually driving those rates up in a minute, but mortgage rates got worse last week, pushed higher as markets reacted to continued high inflation. Everybody knows inflation's an issue, whether you're paying for gas or paying for products or paying for food. We've all seen inflation. And then there were some comments made by Fed Chair Jerome Powell the last week that kind of set the markets on edge. And he was talking about how the Fed would need to raise rates. And when they raise rates, they're raising the Fed funds rate, but it does trickle through the whole economy. And they're going to be raising that Fed funds rate faster and probably a little bit more at a time, rather than raising it 0.25% each meeting. They're looking at raising it as soon as this meeting in May 4th, to another 0.5%. And that Fed funds rate affects the cost of borrowing money across all the spectrum. So that's what they do when they're trying to curb inflation, and we're seeing some pretty bad inflation. So that's how they're going to handle that. And although the Fed doesn't set mortgage rates are influenced by those Fed actions, and markets reacted to that news. And that's what really sent rates up last week, was the expectation that we could see the Fed act faster and take a little bit more action than originally expected. This week, I was expecting that we could see rates move higher. It's been a very strong trend. But the last couple of days, we've actually seen not rates improve a lot, but we've seen them at least stabilize. In some instances, you may actually even see a little bit of a credit on your closing costs that you may not have gotten before. So that's actually good, but I have bad news, and I'm going to tell you about that on the next slide. I do think that rates could still move higher. Mortgage rates have a good chance of continuing higher this week, mainly as investors continue to react to that increased inflation. And remember, we're getting inflation not just from our normal sources that we've grown used to, but also because of what's going on in Russia and Ukraine. That has affected the global supply chain, the commodities, things like wheat and fertilizer and certain precious metals that we don't really pay much attention to that go into your batteries and things like that. It's really created a cost run up there, and that's going to trickle through the entire economy. And that's the inflation we're getting as well. So the Fed is talking about increasing policy rates faster. There's almost zero chance that rates will move move lower from here this week or anytime soon. And when I say rates moving lower, I mean with any kind of significance. You'll see small day-to-day movements, but you're not going to see anything where if you were hoping to hold off because rates are going to drop back down a half a point or 3/4 of a point, don't hold off. You want to keep moving
I think there's
forward.
some of them out there thinking it's going to drop like 2 points. They're like,
Yeah.
oh, it'll come back to the twos.
Yeah, hoping is not an investment strategy. That's for sure. And we're all emotional and we all have FOMO, fear of missing out. Nobody likes the idea that we've missed out on rates when we've seen them get lower. So Nathan, pop that back up on me for 1 second though. I just want to show real quick one more slide on this. So here's a quick outlook. Friday, we could see rates worsen this week. You guys all want to be aware. Talk to your mortgage professionals if you are currently in under contract, or if you're not locked in yet. Talk to your mortgage lender and ask them about if you want to make sure that you're locked in before Friday. Get their opinion and you do what's right for you. Friday, we could see rates move higher on jobs data, and jobs data is important because it opens the door for the Fed to go ahead and raise rates quicker and maybe see a half a point rate hike in that May meeting rather than a quarter percent rate hike. And the Fed would look for the jobs data to come in and support a strong labor market, because the Fed is trying to keep employment numbers up as well as keep inflation down. That's part of their dual mandate. Over the next couple of weeks, rates are, we could see them stabilize a little bit. They could creep a little bit higher. My biggest concern is next Wednesday, and it's actually right around when we talk. It's right after when we talk. So we'll touch on it again next Wednesday, but they should be coming out with the Fed meeting minutes. And those are just the minutes, the notes from the last Fed meeting that was held in March. And investors are going to be looking for signs of what the Fed's intention is as far as the balance sheet. And that's what you don't see a lot of press. You always hear a lot about the rate increases, but the Fed, they own trillions of dollars. What happened during the pandemic is the Treasury created trillions of dollars. They're actually the ones that print money. And then the Fed, they actually buy those treasuries and they buy that debt. And that's where we created liquidity and funded a lot of our services through that time frame. And the Fed does not want to own all these treasuries. So they're going to be, and mortgage-backed securities, actually, all these bonds, all these assets. So they're going to be releasing them back into the market instead of reinvesting them. And that's going to drive up supply, which tends to push down the prices, which is bad for mortgage rates. And then in the next 30 days or so, rates are likely to be about the same, maybe a little bit higher. They're more likely to run that way than they are to improve. It's still a little bit of a dicey call to try to forecast exactly where we'll be. Sometimes it's pretty easy. There's certain variables that are going to come into play that you can say, okay, this is how the market's going to react to those. But right now, not so many of those, which is why we have to be a little bit more whatever. And just that last piece, I'll say, where do mortgage rates come from? And that is, there's two things that come into play when you're looking at mortgage rates. So there's the bond market, and specifically we track what are called mortgage-backed securities. And we've got these fancy charts like you see up there that we watch. And that's what your lenders are using as the baseline for mortgage rates. And the reason that you'll, of course, want to shop around is because you're also going to see lenders that have different lender margins. And the margins are their costs and their profits. So it costs a lender money to do a loan. They've got to pay staff and handle all the processing and the underwriting and the closing of that loan. And then there's the profit that they're also looking to take on top of that. So there's a margin. And if it's really just a simple equation of what is that baseline for where these mortgages, are pricing at, and then what is that lender's margin? And that's where you come up with what you as the consumer are going to pay. So that's why we want to, we can't really control what happens in the bond market, and that's more universal. But by shopping around, you're going to see those lender margin variances. And sometimes there's lenders that are not as efficient, and not that they're greedy and not that they're trying to take advantage of you, but their model just may cost a little bit more money to run, and therefore you're going to pay for it as the consumer. So, it's not always that somebody has nefarious means or nefarious intent, but sometimes just the ultimate. So that's it. Thanks, Nathan. You can turn it all off. So what do you think, Christopher? Where do you want to go from there?
I think the chart was cool. At the very least, it's a very pronounced progressive fall off there, which is, I think, indicative of kind of what everyone's seen over the last week and a half, 2 weeks with interest rates. Yeah. I think from real estate agents to title, like most people in the industry, I don't think had a good idea of the change that occurred for everybody in the mortgage industry specifically because of what was going on there. So I think understanding is catching up to where we were all at. So if you hear or someone says something about your rate's bad or this, that, don't react to what other people tell you. First of all, shopping, is Hammer just described, a company's margin or price is predicated on their cost first and their profit second, right? And so as unique as each of those companies are, and all of those companies out there, they're all going to price differently at different times against each other. And then they're also going to change, whether it's being more aggressive with a certain product profile for a while and then backing off of it for whatever larger risk determinations they're making. They change so frequently that you can't just trust one thing or one label or one thing on the wall. You need to shop. You need to get an assessment same day, same time from the companies that you're looking at that have good standards of consistency, efficiency, knowledge, optionality, right? Pricing as well, reviews. You want to seek all of those things out because this kind of market, as all of the home buyers in here know, it's been a little nuts. Y'all are going through some pretty rough times. I'll say it's not the only time that we've seen this in the last 10 years, just especially depending on the markets that you've lived in out there. But the key to winning is not quitting, being consistent, looking at your NMLS or MLS drip campaigns or your listings, the new properties being listed daily, and then reacting to that quickly, especially in these markets. And the professionals supporting you, the real estate agent and the loan officer, right? And really the title rep behind the scene, they don't get enough praise. But that team, there's so many people that work on that process for you. Find the people that you like, that are responsive, that communicate well, seem knowledgeable, right? And then shop them, right? Don't just trust blindly, trust but verify. It's why we have the slogan on the wall. I think as far as other things to talk about, I mean, did you see my GIF that I posted yesterday? Because I was inverted.
I did see Maverick come out. Let me talk about the chart before you talk about inversion, though. I'll use inversion to talk about, you would invert this chart, meaning you'd flip this upside down to see what happened to mortgage rates. As these are the bond prices, y'all. So as bond prices go down, rates go up. That's the relationship. And you can see this dates back to April of 2021. And you could see there was a range where rates were kind of just steady through here as bonds were steady through here. And again, if we flip this upside down right here, rates would have gotten a little bit better. Then down here, they would have gotten just a little bit worse. Then they got a little bit better. And you can see they were within a very small window. Look at the size of the gap between these two yellow lines. And then this white line is the beginning of this year. And you can see that since the beginning of this year, you know, how many of those 1, 2, maybe 3, almost 3.5 times that change that we've seen in just 3 months. And that's why you've seen such a move heavily in rates, is because of this drop off right here. And this line, just as it, you know, plummeted, for lack of a better adjective, all the way down. So now Maverick, when did they start doing that? It wasn't like Tom Cruise, like 22 when they started filming the second Maverick movie, because then they're just finally releasing it.
I don't know. I don't think so. I mean, he doesn't look like he's aged a lot. Not trying to give Tom Cruise shout outs or anything like that, but yeah,
I was excited to see Maverick, the Top Gun sequel. 2 years ago, they were supposed to come out, and then COVID killed it. That was one of the worst things about COVID.
Yeah, well, it's out now. And so a lot of those people, when I posted that, thought I was actually just kind of celebrating the fact that it was out. But what was I talking about, Hammer?
I don't know. You're going to have, I have given up trying to see other people's heads. Tell me what you were talking about. Make it easy for me.
Inversion?
You're talking about the yield curve inversion. See, now I got you.
I think there were a few people that got the joke, just the weirdest ones in the group, but there were only 2 types of friends I had on that post: those that were ready to watch Top Gun 2 and those that knew about bond inversion and what was going on there to a degree. So
yeah, the 2 and 10. So why don't you tell everybody why it's funny, because a bunch of the other yield curves have already been inverted, but it's like the 2 and the 10. It's like Hollywood stars. So those are the ones that get all the attention.
I think track record's why that one's probably looked at more than most. And for the record, I'm not a bond economist or anything else. I listen to some people that are, and I understand it to some degree, but inherently, like every economic cycle goes through regular expansion and declining periods, right? It's kind of a process. And when the future outlook or the long-term outlook and the short-term outlook invert, it basically is somewhat indicative, not by itself at all, right? There's a lot of other things that kind of go into determining when the expansion's over and when you're going to start to see some retraction from there. But it's been, at least I think historically, a reliable precursor to periods of retraction economically. And so retraction, I think, is the R word that I want to use here. given a few that I could choose in that, because there's a lot of other things going on. Like you said earlier, the jobs market really healthy right now. There's like 11 million jobs, I think, something like that. I don't know what the number is today, but very strong job market, which is also indicative of growth and expansion, right? Economically. So you have a lot of other kind of unique things going into it. I'm not, again, the economic surgeon to dissect it all, but that's my on the street level understanding.
One thing that I've learned about. So for everybody that may not understand why a yield curve inversion matters. So basically what we're tracking is what is the yield of a bond or a note that is going to pay off 10 years from now versus one that's going to pay off 2, 3, or 5 years from now. And ideally, ones that are, I always get this backwards. So let me see, short-term yield versus long-term. Yes. So short-term yields are lower than long-term yields because you're expecting a bigger reward for your money for the long
time value of money.
Yeah, it's time value of money. So what happens is when a yield curve inverts, it means that the shorter term is actually paying better than the longer term. And that's backwards and that's confusing. And the way the media makes it sound, the way that we hear it, it's like, okay, this happened. We're going to have a recession probably Thursday or Friday, like it's just going to boom. And I didn't realize this is an indicator, but generally the recession comes 18 months to 2 years later.
Oh, is that really? I thought it was a little sooner than that. I thought it was 6 to kind of a 12-month on that. I'd have to go back and look.
Show me. I'm Googling it now because I'm looking at the last.
Google also, if you Google current interest rates, Google's going to show you some current interest rates that if that's what you're seeing, shop for the love of everything. Just go shop. Trust me, because Google's not the best source for that information on what
I agree, but Google is the resource to point me to the sources. So according to Barron's, they're saying it usually takes anywhere from 12 to 24 months for the economy to retract. And there's so many things that could actually affect it. And I think this one may be the exception that proves the rule. I'm not saying that I don't think we'll see a recession. I'm just saying that the variables are different. The pandemic really did make this a very different economic time. It's something that we haven't dealt with in this same scenario, even though there's similarities to 1994, like I talked about last week, or even to the 70s and 80s. It's still different. So,
yeah, well, still strong indicators of growth that are out there. It's something that we want to pay attention to and at least discuss on the superficial level to maybe cause some people to scratch heads. Go out and do your own Googling and looking up source information, same way that our moderators source the information behind your questions here, because we want you to be informed. We want you to arrive at your own reasoning and understanding and knowing what was significant to consider to what you decided that you believed, right? So learn these things, pay attention to wherever you can, follow along here, and we'll help you out the best that we're able to. But I think that just about wraps it up. Hammer, what else? What other?
One other thing I will say is that with rates going up, there's a lot of idea that maybe home prices are going to come down. And I think repetition is important because different people are going to see different episodes, if you will, of when we chat. And that is not what has been happening. Even though rates are going up, and unfortunately, it does make it so some people no longer qualify and aren't going to really, maybe they're going to have to work a little harder to find a home that they can qualify. We talked about that last week a little bit, but there's still a huge demand and there's still a lack of supply. There's not enough homes being built. There's not enough people getting out of the homes. There's talk that because people have locked in low rates, they'll be more hesitant to move out of those homes now. So all of this, we had a couple of different reports that came out about home values and how much housing prices have changed. The Case-Shiller report, one of the ones that are most watched, home prices nationally rose 19.2% year over year in January. So you're talking almost a 20% increase in January. You could say, well, rates really hadn't gone up. So we're going to see that number come down. It may not be 19% in February's numbers or March's numbers, but you know what you are going to find is it's still going to hold steady. Don't get caught up waiting is my advice. You're not going to see home prices drop down significantly while rates creep up. If you can get out there and buy a home, it is one of the best investments that you can make in yourself and your family. So.
Yeah, and either way, you're going to be paying for shelter unless you're going to be living in a tent or off grid somewhere. Actually, I know a lot of vets say that and definitely don't follow through because who wants to live in a tent for the rest of their lives? But if you're going to pay for shelter, outside of the value of shelter that you get out of it, consider the cost, the short-term and long-term cost, the difference, right, between renting and buying. And there are other costs outside of just the mortgage payment, right? Maintenance, capital improvements, those are legitimate costs. But the only difference in the two is with owning, there's potential growth of value, and there's other benefit that kind of come along with it. So you get the shelter plus, as opposed to just the shelter. The interest rate on rent, guys, it's 100%. In case you haven't been following along with Facebook meme from mortgage people here lately, but it's kind of a true statement. So hopefully that does inform you all. I think I agree with just about everything there, Hammer, on supply, demand, and what that's going to continue to do with prices. I think it's absolutely insane out there as far as what real estate's doing. And the problem with that is because of supply and demand and inflation specifically, I don't know. I don't see necessarily, there's not some cliff, you know.
No.
Unfortunately, there's too much demand. And there's not
this is not 2008. It's not a bubble, folks. We've been
and if you're a vet coming in here
time.
and you're like, well, what does the supply demand mean? Let's just say that everyone in your squad decides that they only are eating number 15 beef raviolis out of the MREs for the entire deployment. And so you have like 20-some people fighting over 2 boxes of MREs with 2 of those beef raviolis in there. And so now 20 people are fighting 3 meals a day. You know what I mean? It's like there's just not enough to go around of that specific thing. And so you have to get creative. Look at renovation type products, right? Look at houses that have deferred maintenance that you can improve and create value in. Look outside of the central areas that you're focused on as well. Look for the places where things are growing if you can tolerate a little bit of lateral movement, but be different and look at the market differently to experience success. If y'all have questions, hit us up. Outside of that, I think that's a wrap.
Awesome.
Awesome. Appreciate your time, Hammer.
Take care, everybody.